Hi everyone, and welcome again to Nettle, the go-to place to learn about business, finance, economics, and much more. Please don't forget to subscribe to our channel and click that bell notification button below so that you never miss fresh videos and tutorials you might be interested in. Many thanks to our current Patreon supporters and YouTube members for making this video possible, and we'd also greatly appreciate if you consider supporting us as well. So please check the link in the description and click the join button below for more details. My name is Sava, and today we're investigating something that has been quite frequently demanded recently, which is how to build an efficient portfolio frontier in Excel with constrained weights. Because obviously you could build an efficient portfolio frontier using a closed form solution for the formula for the relationship between risk and return using matrix algebra, but only when you're allowed to short sell indefinitely and take on unrestricted leverage in stocks. And this is the objective of the Merton matrix model that we investigated quite a while ago, so check this video out if you're interested in frontiers without constraints. However, if you would like to apply constraints on your weights, for example, demand that no more than a fixed percentage is allocated to any of your sample stocks, or that no less than some percentage is allocated to all of your stocks, so if you've got top or bottom exposure limits, or both, then the solution for the efficient portfolio frontier becomes way less trivial, and you have to use numerical optimization, for example solver, to address this. However, building a frontier out of it is still not trivial because you have to pursue a number of optimization tasks at once. And it is not clear necessarily how to do it in Excel. So today I'll share some interesting tips and tricks how to build a 10 stock efficient portfolio frontier with any sort of allocation constraints that you can possibly imagine in Excel. And we've got 10 stocks to help us do that. We've got 10 years worth of daily data from October end 2012 all the way to October end 2022, and we've got 10 well-established US stocks from various sectors for diversification purposes to make it more realistic, alongside the S&P 500 index values to construct betas and expected returns using CAPM. So let's start by simply calculating daily returns for all of our stocks in the market index, dividing the price or the total return index today by the value yesterday and subtracting 1, applying it for all 10 stocks plus the index and for all sample days. Then we can calculate betas, calculating the slope of every single stock against the respective market returns in a particular day. We can lock the columns for the market index, as the market index is the same for all 10 stocks. We can see that Apple is slightly riskier than the market with a beta of 1.17 on average. And we can drag it across and see the market risk exposures of every single of our stocks. We can see that Pfizer and Walmart are quite defensive, Disney and Caterpillar are quite in line with the market, whereas Delta Airlines, Goldman Sachs, Apple, and to slightly lesser extent Google are quite aggressive stocks with higher than 1 beta loading. Now, to calculate expected returns, we need to make an assumption about the risk-free rate. This is generally a yield of a government bond that has got the same maturity as your investment horizon. So I picked a US, as all those stocks are US, government bond yield for a 10-year maturity. As of October end 2022, it was quite high, in excess of 4%. So I'll plug in this value, 4.05%. And the market return for long time periods can be approximated using historical returns. So we can simply divide the value of S&P 500 index at the very end by its value at the very beginning, raise it to the power of 1 over 10, simply because we've got 10 years worth of data, and subtract 1, and we get a market return of 10.61% per annum on average, which is quite realistic. Generally from stocks, you expect 8 to 12% per annum if you're looking at a broad market index. And now for the expected return, we apply CAPM. We have got our risk-free rate. We need to lock that. We add individual stocks beta exposure so we don't lock it. And then we multiply it by the market risk premium or equity risk premium, which is market return in excess of, so minus, the risk-free rate. And we see that stocks with high beta exposures have higher expected returns. So Walmart in our sample has got the lowest expected return due to its low market risk, low beta exposure of 7.5% per annum, whereas Delta Airlines has the highest expected return at 12.5% per annum. And now, to fulfill our task of constructing the frontier, and more importantly, to identifying the boundary points of our constrained frontiers, let's rank these stocks in terms of their returns in ascending order and descending order. So descending order first, we can rank every single return in comparison to all other returns. So this needs to be locked, and we pick 0 for descending order. So we can see that Apple is the first highest returning stock, Delta is the most returning stock, and Walmart is the stock with the lowest, with the 10th highest expected return. Now we can rank them in ascending order as well, substituting this 0 into a 1 to convert our ranking procedure into ranking with ascending order. And here, again, quite naturally, Walmart is the lowest and Delta is the highest, with all other stocks in between. Now, to determine our boundary points, our points on the frontier with the highest return and lowest return possible, we can count how many stocks we've got. So we can just count the returns, or betas. So we just count this sort of a row, and then we input our allocation constraints. And obviously this has to do with investor guidelines, investor profile, perhaps your risk tolerance. You would be willing to hold more concentrated portfolios with less stringent exposure limits if you are less risk averse. So let's start with something quite non-trivial. For example, let's say that our minimum allocation is 1%, so we want at least 1% in each of our 10 stocks. That can have to do with, well, you have research to assemble this investable universe and you want at least 1% put into all of the stocks you spent such a hard time picking for your investment purposes. And the maximum allocation has more to do with concentration limits. So you might not be comfortable in putting more than 50% in every single individual stock. And this is the motivation for establishing those exposure limits. Sometimes they're just mandated by your superiors if you're an analyst or a fund manager, and they just put those exposure limits in place for you to follow. And effectively, what we have to do now is to determine what will be the portfolio that has the highest return possible and the lowest return possible, given those two constraints. And those tasks will be very similar, and we'll just need to use two different sorts of rankings that we've just assembled to address that. So first of all, how many stocks will there be with the highest allocation here? And to do that, we have to use the quotient function and see how much budget do we have to allocate our maximum exposure to. So first of all, we need to make sure that we do provide our minimum allocation. So we subtract from 1 or 100% that we've got, all of our budget. We subtract the total number of stocks times the minimum allocation. That is what we undeniably have to invest. You would not be able to avoid investing at least 1% in 10 stocks if this is what's mandated. And then we need to perform whole division, so quotient, onto what's remaining between the maximum allocation and the minimum allocation. So this particular difference. Because if you've got 1% invested in a stock and you want to top it off to reach your maximum allocation, well, you need to invest additionally 50% minus 1%. And we can see quite intuitively that we can only afford one stock with the maximum allocation of 50%. If, on the other hand, we didn't have a minimum allocation, you'll be able to invest in two stocks because, well, you just select two stocks with the highest returns, put 50% in one, so Delta, and 50% into the second highest return, so Goldman in this case. But let's stick with the minimum allocation that's non-negative. Just for the sake of generality, we'll be able to play around with those exposure limits in quite a bit. And in terms of the stocks that will have the lowest allocation possible, we'll need to consider the following. As we fill our budget, our allocations in, we'll have several number of stocks which are at the top, which are at the highest allocation, some stocks that will have the lowest allocation possible, and one stock that will be at the boundary. And for the bottom constrained stocks, well, you'll have one stock that you'll be able to exhaust your maximum allocation for. Then you'll have some stocks that will have the bottom allocation, so the minimum allocation possible, but there will be always one stock that's somewhere in between, which you would have liked to tip towards maximum allocation, but you just run out of budget, which means that there will be this one stock, and the bottom number of stocks, so the stocks with minimum allocation, would be the total number minus the number of stocks with the maximum allocation possible minus 1. And that's why we can use this particular logic to calculate what is the remaining weight in the stock that is stuck in the middle, that we start topping up towards maximum allocation but run out of budget. And that is easy to do. We can subtract from 1 our total allowance, 100% of capital, the maximum allocation times the number of stocks with such allocation, minus minimum allocation times the number of stocks with said allocation. And we can see that the second stock, so the stock that's lingering between the top and the bottom, because we have one stock at the top now, will have a 42% allocation towards it. And that will allow us to construct our portfolios with maximum return and minimum return, which will serve as the boundary points for our efficient frontier. And by the way, if you're just interested in exposure limits on their own as a portfolio construction tool, please consider viewing this video that we've got here for you. But back to maximum return portfolio, what we'll have to do is use a set of if functions and carefully utilize the calculations we have already performed. So if the rank that we've got for our stock here is less than or equal to the top, then we're selecting the maximum allocation for the stock. So in our case, 50%. On the other hand, if the rank of the stock is greater than or equal to our top plus 2, which means it's in the bottom stocks, we would have the minimum allocation imposed. And if it's neither, so it's our midpoint stock that we top towards the maximum allocation but run out of budget, we'll need to impose the remaining allocation to it. And that means that for our portfolio here, we'll have a 50% allocation into Delta, the highest returning stock, a 42% allocation into Goldman, the second highest returning stock, and 1% allocations to finish it off in the 8 remaining stocks. And if you have a look, the sum of the weights into these 10 stocks do indeed sum up to 100, as we have performed all of these calculations carefully. But what is quite good here is that if we drag it down and drag across, we'll have the similar solution to the problem for the minimum return portfolio. As you can see, for the minimum return portfolio, we have got 50% allocation to the stock with the lowest return, a 42% allocation to the stock with the second lowest return. We can see those ascending order ranks shown up here, and 1% into stocks with higher returns each. Now, to make sure that we can carefully compare our constrained frontier with an unconstrained frontier, and as well to perform all of the necessary calculations for our optimization, we need to construct a covariance matrix. And I'll use an index method. And if you would like to know more about constructing covariance and correlation matrices, please consider checking this video here. So we apply the covariance.s function, and then we input an index function there, selecting a range of all our stocks. So we don't select the index here, and we select the first row and lock it, both column and row wise. Then we use our first index variable, which is over here, and lock the column. And finally, for the first stock that we pick for our covariance calculation, we refer to the very last row of our returns. In a similar fashion, we'll lock that, and we refer to the same index variable. And then specifying our second stock, we can just copy that across for time-saving purposes and change the index variable to the one on the top, with locking the row instead. And as we've got daily data and our returns are annualized, to make it a level playing field, we need to analyze covariance as well. And as there are 250 trading days in a year, we multiply by 252. Dragging it across and down constructs a 10 by 10 covariance matrix for our stocks with variances at the diagonal and covariances outside of the diagonal, and you can see how symmetric it is, which is a sign that we've performed the calculation correctly. And we can see that the unconstrained frontier has emerged on the chart to the right hand side. Again, I have not gone through the matrix calculation for the unconstrained frontier here, but check out the Merton matrix model video for that. Here we need it only for comparison purposes to our constrained frontier. And for the constrained frontier, for our max return and min return points, our boundary points, we can quite easily calculate the risk and return for them, and we'll use it in further optimization as well. So for the risk, we need to matrix multiply our weights, and we don't lock them because we might want to move row to row and get various portfolios down the line that will constitute our frontier at the end. Then we'll insert our covariance matrix here into the matrix multiplication function, and we'll lock that because the covariance matrix stays the same. And then we matrix multiply it again on the right hand side by the transposed vector of stock weights, which we've got here. And again, we do not lock that because we might want to drag it down or copy it down to perform this calculation efficiently for any number of portfolios we want. And finally, to calculate volatility and not variance, we take the square root of the expression. That allows us to know what is the risk of our maximum return portfolio given the constraints, and we can drag it down to see what is the risk of our minimum return portfolio given the constraints. And for the return, we just sum product our CAPM expected returns over there, and we lock them because they do not change portfolio to portfolio. Those are the initial assumptions we make and stick by. And we refer to the returns that we, again, do not lock. And we can see that the maximum return of our investable universe given the constraints is 12.09%, and the minimum is 8.12%. So it means that there is a range of roughly 4%, or 3.97% to be exact, between our maximum return portfolio and our minimum return portfolio. And that's what we'll use to construct as smooth of a frontier as possible. And here we need to consider the limitations or the constraints of Solver itself that we'll use to perform our numerical optimization further. Solver can only handle problems with less than 100 variables. If it's 100 variables or more, Solver just tells you it's too complicated of a problem to address. It's just a hard-built constraint on Solver. And as we've got 10 stocks, we cannot calculate more than 10 portfolios at the same time, because our variables would quickly overflow the number of parameters that is possible to vary in one Solver task. Obviously, you could perform the same procedure with more portfolios and achieve even high granularity if you are willing to do Solver optimizations one by one. But as this is quite time consuming and I wanted to build as efficient of a template as possible, I'll stick with just 10 steps, which will construct 11 portfolios. And this would be a large enough number to achieve a smooth frontier. So what I'll do is I'll divide this range by 10, and that would constitute my step. So I'll gradually reduce my return from 12.09%, the maximum return, to achieve the minimum return and have portfolios along the way that would nicely blend into our frontier. For that, what I need to do first is to refer to our maximum return weights. I was just referring to those there. Then, for the constraint on return, I'll refer to the max return over there. Then I'll check that the sum of weights is equal to 100% indeed, and it is. And for the risk and return that are calculated, we can just copy the formula that we typed in on top across, And this, due to the fact that the covariance matrix and the return selection is locked, but weights are not, will correctly generalize this formula to any portfolio we'll type in here. And that's quite handy, because now we can move in steps of, well, 0.4% at a time on average, which would allow us to go from the maximum return portfolio all the way to the minimum return portfolio here with 8.12% at the bottom. And for this portfolio, we are simply referring to the minimum return weights at the top. And again, the sum of weights is equal to 100%, and our risk and return are identical to the ones we calculated there. But how to fill in the gaps? This gap that constitutes 9 portfolios, 10 stocks each, so 90 variables. We could not have gone for one more, as that would reach 100, and that would overflow Solver. For that, we start with equally weighted portfolios across the board. So just fill in those weights with 10% each, make sure that they sum up to 100%, and calculate the risk and return. Obviously, as this is the same portfolio now, our risk is 18%, our return is 10%, they are the same, but what we need to achieve is to match those two return columns. So we want these returns to be equal to those returns. We want these weights to match with our allocation constraints. And we want our sum of weights to be equal to 1 all the way. And we can see that the frontier now does not look particularly good, and that's because we haven't optimized yet. And for optimization to work in one go, so we can efficiently build frontiers for various investable universes or various sets of assumptions, let's just minimize the sum of risk for these 9 portfolios that we optimize. Because remember, we already have built the boundary points, we just have to fill in the blanks, fill in what's in the middle. So if we minimize the sum of risk, subject to a constraint on returns, a constraint on the sum of weights, and finally, honoring our allocation limits, we'll be able to fulfill our task. So we go to Solver and we specify what we want to do. We want to minimize the sum of risk by changing 90 different weights. 10 weights across 9 portfolios. They can all change pretty much independently. We now need to add the constraints that we are looking for. So first of all, we want the returns to map our return constraints. So these returns need to be exactly equal to the returns we have calculated for our steps. So that's the first constraint, and perhaps the most important one. And the other constraints are quite usual and quite intuitive. We want those sums of weights to be equal to 1 exactly. And we also want our exposure limits to be honored. So first of all of those weights needs to be less than or equal to our maximum allocation constraint. And we also want our weights, which are over here, to be greater than or equal to our minimum allocation constraint. And given we have constrained everything we needed, we can untick this box. We do not want to specify non-negativity. We might want to play around with it in the future. And we can stick with the gradient descent algorithm, click solve, and specify our task. And wait until it converges. And the solver has just converged in fulfilling the optimal task. We can see that the returns are now matching the constraints exactly. We have got weights that are changing all the way through. And we also have got our frontier plotted there in blue alongside the unconstrained frontier in orange. We can see that for quite an extended period of time, or rather alongside quite an extended range of risks and expected returns, our two frontiers overlap, because at this point none of our constraints are violated. However, we can see that when they start being violated, our constrained frontier becomes much flatter, much less steep than the unconstrained frontier. We have got less of a feasible set due to the constraints we put in place. And that's most obvious here at the boundaries. So now let's play around with the constraints and see what it will do with our frontier. So first of all, if we go for the most natural and most common constraints imaginable, so 0% minimum allocation, 100% maximum allocation, which is effectively a constraint on short selling. So you're just not allowed to short sell, anything else is a fair game. We can see that in that case, our maximum return and minimum return portfolios are quite intuitive. They're just portfolios with 100% allocated to the highest returning and lowest returning stocks, which is again a good sanity check that our procedure here was correct. And we just run solver again and allow it to converge to a new efficient portfolio frontier. So let's see how this shape changes and what that says about the nature of constrained portfolio optimization. So now we can see how the shape have changed, and that we have got a less bounded frontier, which does overlap with our unconstrained one for a longer range of risks and expected returns, and it allows us to achieve both lower returns here at the lower end and higher returns here at the higher end, due to these constraints being less binding. However, what will happen if our allocation constraints are very stringent? For example, we are not allowed to invest more than 20% in anything and less than 5% in anything. This would squeeze the frontier quite a bit, but it's not yet the correct frontier as we haven't optimized yet. So now we can go to solver and solve again for the new very constrained frontier. And we see as our optimization algorithm converges, this tiny thing that is barely visible is now our frontier. We can see how small our feasible set becomes due to quite stringent constraints we put on it, and how small is the range of expected returns and risks we can achieve with such constraints. But we can even play around with short selling, and here then the minimum allocation becomes the maximum short position that is mandated. So for example, if you are allowed only 10% short sells and for example 50% maximum allocations, we can see what it does to the nature of our frontier. This particular procedure makes our frontier way more in line with the unconstrained frontier for a longer period of time, or for a longer range of risks and expected returns, due to the fact that these short selling constraints have been lifted. And you can play around with your investable universe, with your returns assumptions, and with your allocation constraints to produce a wide range of comparisons between constrained and unconstrained frontiers, and see for yourself which is giving you a more desirable pattern. And what is even more important is that there is a way of implementing this procedure way more flexibly with a more granular frontier, which is sometimes useful, especially if you have a large number of stocks and you need to piece out a lot of the calculations involved. But that, unfortunately, will not be implementable in Excel that seamlessly. Again, as I told you before, you might need to run solver multiple times consecutively for the same simulation due to the limit on variables. And for that, you'll need to use Python. So if this video reaches enough likes, I'll most certainly do a video on constraint optimization in Python and see how efficient and beautiful it is. As for now, that's all there is for constraint efficient portfolio frontiers with solver in Excel. Please leave a like on this video if you found helpful. In the comments below, I'll make you any first suggestions for videos you would like me to record. And please don't forget to subscribe to our channel, consider support on Patreon. Thank you very much and stay tuned.